Good morning again, and we are now going into our final panel about business cycles, growth.
Panel this morning.
Sorry?
There'll be another panel afternoon.
Yeah, in the afternoon, yes. Sure, it's the last panel of this morning. Thank you for the correction. About business cycles, growth, and macroeconomic policy. And I hope it will be mostly about policies and the balance and mix of policies. But I also hope that some of the debate of the first session will filter down to our discussions. I hope, because if we are thinking about policies going forward, we also have to have a view on what are the main elements of the narratives that can explain why the recovery has been slow and long, and that's important then for thinking about the policies. And the first session was rich in that aspect because first point, I think it's useful to reflect a bit, is about the relationship between cycle and trend, cycle and growth. Of course, in terms of economic theory, we separate the two things perhaps too much, for we need abstraction to make progress in thinking, but in real life, there is really no such clear-cut differentiation. As John Hicks said, when you think further ahead, you are already in the field of history and not mechanics. And so we have these nice models that have this steady state that represents the long run in logical time, but not in historical time, because in historical time, the long run is just the result of the accumulative effect of many short times, of course. And so there are many papers that show that the cycle influences the trend, that indeed the recent crisis left permanent scars in potential. There are many papers illustrating that, and we should not separate too much, which then impinges on the debate about which is more important, demand side or supply side, and the calculation of TFP. Because if indeed we consider that the cycle and therefore demand has some effect, a permanent effect, and affects the potential, then we should not isolate, and in particular, in the calculation of TFP, we have to consider the possibility that Charles mentioned of some degree of reverse causality, has, say, he illustrated with labor, but also true with investment. Because hysteresis, by the way, affects labor, but also capital stock. Because if investment goes down during a long period of time during a recession, that also affects both the quality of the stock of capital, which is not updated, and that has long-term effects. And so the investment affects the residual. And so it is true, as Bob Hall said, that when you calculate, the residual is the residual. So there is no question about being exogenous or not. But what is different is that you then call that residual, which is just arithmetic thing, TFP. And if you call it TFP, you are making the assumption that the technological progress is X neutral and disembodied from investment. And that's why you say, well, this residual is total factor productivity and all that. So, as Gotti said, TFP can be all over the place when we calculate and when we try to interpret it. And so to treat it, this residual, just as TFP, indeed needs an assumption that makes this thing exogenous. But that's controversial. One of the students has a paper, Martin's reader has a paper on investment and productivity where precisely he shows how investment affecting productivity affects TFP. And so the two things are not disconnected. So that's part of the debate, because when thinking about future policy, we also must think necessarily about the main narratives that are related to the answer, the question as why is the recovery being so slow and long? And there are three main narratives, as we all know. So it's a demand-driven thing. Well, certainly the crisis was a big negative demand shock. I hope that one disputes that. It was not a technological shock, as Chad Jones illustrated. It was nothing happened suddenly in 2000. So it was a big negative demand shock. And then the question of the slow recovering being also mostly demand-driven is then related with the effects it had on consumption, investment, and then in the extreme, the story of secular stagnation coming from the demand side. Then we have the second narrative is about supply. Everything is about supply. And well, it has been slow and long because there is a decline in TFP, and that was coming already before the crisis. Well, is it autonomous? The first point creates a doubt about that. And also, it was an interesting exchange in the morning when someone asked if the fact that if it was supply lacking, then why didn't prices increase? And then Bob All answered, well, yes, this gap does not explain the second derivative, a change in the rate of change. But certainly, if demand would have been adequate and good, and only supply was lacking, so prices would have been higher, and we would have perhaps a little higher inflation rate that we are having. And the third narrative is, of course, the Rogoff narrative about the hyper cycle of debt overhang that has to play out, and we have to wait that this plays out, and then we are again in good things. So that leads us to the policies, and so I hope that the panelists will discuss the different policies, monetary, fiscal, structural reforms, all that is relevant, and what is the mix that now is needed. If we can have a better mix that will produce more inclusive growth going forward. And also regarding the monetary policy, what we have to do in this moment. President Draghi mentioned the problems of interpreting the slack and the possibility of the slack being bigger than the more common official measurement of the slack, and what that implies to monetary policy. Should we persist? Should we continue to believe that inflation is always a monetary policy issue? Or should we capitulate, like the recent annual report of the BIS seems to suggest, and accept the idea that central banks and monetary policy do not really control or can fine-tune inflation? So these are big questions, and we have an excellent panel to discuss these and other issues because we give a lot of freedom to our members of panel to choose their angle. They only have 10 minutes, so we have to give them freedom. Also, two of them will have slides, two of them will not have slides, so again, it's something that we indicate that we allow. And as I said, we have a great panel here, starting with Agnès Bénassy-Quéré from the Sorbonne University, Paris, and also a member of the Conseil d'Analyse Économique. Then we have Mark Booty, Director General of Economic and Financial Affairs Directorate in the European Commission, and also the representative of the Commission in the G7 alternates. We have Sergei Guryev, Chief Economist of the European Bank of Reconstruction and Development, and we have Simon Johnson, professor at the MIT and former Chief Economist of the IMF. So after conferring with the members of the panel, we decided that the first to go would be Marco. So please, Marco.
Okay, thank you very much. Thank you very much, Vitor. Great to be here. Actually, my presentation is quite complementary with the one of Philippe in the previous in the previous session. Okay, I warn you, in case you're worried, my presentation will be much less animated than the one of Philip, but nonetheless, hopefully, you can see a bit the interplay between the two. Why I say complementary? Because he looked at the interplay between functioning of markets, so structural reforms and monetary policy, and I look at the interplay between structural reforms and fiscal policy. So maybe eventually one could find some sort of a unified conceptual framework that could help. I mean, I tell you the bottom line of my presentation already, so if I run out of time, you will have it, is that what we have seen, especially during the crisis, is complementarity between fiscal consolidation and structural reforms, but this does not necessarily imply that this should be the same or it's a model for the future. Now, going back first to the debate, I've synthesized here, I mean, the different views that there are many papers, so I just took some of them. I mean, there are the either-or view. So basically, you have either you do fiscal consolidation or you do structural reforms. I think there are political economy explanations for this. I mean, you have a limited amount of political capital to do difficult things. Either you spend one way or spend in another way. You have the fiscal expansions needed to offset temporary output loss induced by reforms and to buy consensus. This is the either-or view. Then what I dubbed here actually was in Sapir report back in 2003, 2004, say the Brussels-Franco consensus. I mean, the two things go hand in hand. And then something that in a paper of actually quite a few years ago, try myself to look at the two things together. And what we find in that paper is that complementarity or substitution actually depend to a large extent on the time horizon of governments. So governments with a high discount rate, so they value the near future very much. They tend to do reforms and fiscal consolidation at the same time. We measure this by the distance to the next elections. Those governments instead who have a lower discount rate, they tend to be more on the substitution side. So this is the, let's say, in very broad terms, the debate that we have. Now, this was the academic debate. These issues here are discussed regularly at the Eurogroup, at the ECOFIN, in more official policy fora. And the view that you have complementarity is very much peddled by certain views. And I put here, especially the German view, I dubbed it the Schäuble curse. But I could have dubbed it the Ising curse. Where is Ottmar there? So I take no offense because I have written a paper a couple of years ago on the Junger's curse. So I think I hit in a rather balanced way. So what is the argument? The argument is that the two things indeed go together. There are a number of statements, but you find many. And essentially, the message here is consolidation. That's my final bullet here in the slide. Consolidation reforms, either they are there at the same time or they disappear altogether. So what matters is overcoming moral hazard, so via market discipline or institutional coordination mechanism and surveillance. And the corollary of this, you have seen the many discussions on the role of monetary policy, but also on the implementation and the flexibility in the implementation of the Stability and Growth Pact, that expansionary macroeconomic policies actually come together with a slackening of the reform effort. So this is basically the allegation. Who wins? If one looks at the evidence during the crisis, and here I put two measures of reform effort. So the labor market reforms during the period of the crisis, 2008-2013, and product market reforms. The product market reforms is the same measure that yesterday Thomas Philippon presented here. The labor market reforms is in-house commission database. And what you can see, I mean, the two seem to go, hand in hand. Crisis-hit countries seem to have been more, let's say, reform-prone than other countries. I think more telling for the topic I'm discussing is this slide here. And here, what I look at is the change in the primary structural balance. So, and when you are on the positive side here is fiscal consolidation, and the decrease in the strictness of employment protection legislation during the crisis period and before the crisis. And what you can see here, I think pretty clearly, is that you have the complementarity clearly at work. So countries having done strong fiscal consolidation, they are also those who have done more reforms on the employment protection side. If you look before the crisis, actually you don't see this correlation at all. That is the graph on the right-hand side. So conclusion is, I think Schäuble seems to be right as far as the crisis period is concerned. So this is the experience that we have. Obviously, some of these countries have been they have done not necessarily in a very voluntary way, only the market pressure, but some of these, they have also the IMF EU programs, which pushed very much into both directions. Now, the question, I think, is looking forward is to what extent this complementarity here is a good model for the future, or for anticipating behavior in the future. And I think, and these are my 3 points, that not necessarily so. The first one is that tackling social implication of the crisis. I mean, we have been okay, you heard with Ben Bernanke dinner speech. I mean, the concern that you have on social inclusion, redistributive factors, etc. So, I mean, tackling the fairness concerns actually reduce the scope for doing harsh consolidation, take some harsh consolidation measures on the fiscal side. So I think there are some tensions there that is developing. And from the political economy viewpoint, the whole discussion on populism, I think, this is a relevant one. The second one is we are increasingly talking of structural reforms 2.0, moving from what is the purely harsh competitiveness-related reforms to reforms that boost productivity, total factor productivity, though the qualification of Vitor. And typically, these type of measures and reforms, they cost money. So there, again, the tension between doing the reforms and doing the consolidation at the same time. And the third point is that it is true, as I've argued before, that fiscal consolidation, structural reform have gone hand in hand. But if you look at the quality of public finances, during this episode of consolidation, it has deteriorated from the point of view of boost to growth. Now, I don't have much time at all, so you find this in the slides. So the first one on income distribution, I think this the crisis has badly affected that. There are many measures of these reforms will cost to the budget. I mean, some of the reforms which really have impact, they cost money. And the third point here is that you can see what is here basically is investment, public investment and expenditure in education. What is below the line is actually a reduction in investment, reduction, expenditure in education. So you see that basically many reforms, consolidation efforts that have been done at the expense of the quality of public finances. So that's my final slide. I think the first is the reason for a substitution between consolidation and reforms, I think, getting stronger looking forward. We try to accommodate that, but the clauses, the reform clauses, the investment clauses in the Stability and Growth Pact are not easy to implement. In particular, there is an asymmetry of information which I think is difficult to manage at the central level. I think we need to move from penalizing to give more positive incentives for structural reforms, I think within the surveillance, but also within the EU budget. And finally, I mentioned at the beginning that the discount rates place on the degree of activism, but discount rates, as you can see, I mean, they cannot be imposed by Brussels. Okay. Thank you.
Thank you. 1 minute. Thank you, Marco. So, Agnes, please.
Thank you very much for the invitation to this super interesting conference. So in the long list of topics you proposed to us, I selected 2 topics concerning the EU and more specifically topics in which I think we are really not very successful so far. So the first one is the European semester, more specifically the macroeconomic imbalance procedure. So for those who are not familiar with the MIP, it was introduced after the crisis because some countries like Spain or Ireland were severely hit by the crisis despite the fact that they were complying with the Stability and Growth Pact. So the idea was to extend the surveillance to not only to the public sector but also to the private sector. And so I'm not going to describe the MIP. Here you have a sample, a euro area sample taken from the last vintage of the last vintage of the semester. And the idea is that to classify countries into those with no imbalances, those with imbalances, those with excessive imbalances, and then there's a 4th category that can trigger some sanctions, but so far there has been no country in this 4th category. So now if I concentrate on the 4 countries with excessive imbalances, we have France, Italy, Cyprus, and Portugal. So I'm sorry it's in French, but the triangles show the unemployment rates, so they are relatively high compared to the other countries. The black squares are current accounts, are relatively low relative to the other countries, and then you have large leverage both in the public sector and for some countries in the private sector, although the difference with the other countries is not so compelling. So these classifications are based on in-depth reviews, which are summarized here, and then we come to country-specific recommendations. And I will spend some time with the country-specific recommendations, which I summarize, and they fall into 3 blocks. The first one is fiscal adjustment. In the 4 countries, one recommendation is to continue fiscal adjustment. Second block is structural reforms. So it has to do with education, justice, administrative burden, depends on the country's structural reforms. And we have a third block, which is not very much represented here, but for other countries it's more important. I must say that all countries receive country-specific recommendations, and not only those in excessive imbalances. And the third block is, I would say, tools that can be used at the margin, so that can be hiked or reduced, so like taxation, social contribution, the minimum wage, things like that, or we could say macroprudential policy tools. I think this is important to make this difference. Why? Because as many reports have shown, the MIP has not been very successful in changing the course of macroeconomic policies in the member states. So we need to ask ourselves what to do to make it more efficient. And in my view, there is a kind of confusion between different processes, which I summarize here. We have an overlap between the Stability and Growth Pact, the MIP, and the so-called Europe 2020 integrated guidelines, which concern the long term. And we can see the same recommendations showing up under different headings, depending on the country, depending on the vintage. And in the MIP, there are so many things that we are getting confused. And in my view, this reduces the ownership at national level. If you go and you interview some members of parliament, you can count the number of people who are just aware of the existence of this. And there is a lack also of time frame because the Commission then has to repeat every year the same structural recommendations, such as improve the quality of education. So this is not something that will change from one year to the next one. So some clarification could be useful by refocusing each process with a small number of objectives, a small number of instruments, and a defined horizon. So the SGP is the most defined process with, well, the objective is fiscal sustainability, the instrument is the government budget, the horizon is short and medium, and we have a flagship indicator, it's perfect. Well, I'm not saying that the SGP is perfect, but from this point of view, it's well defined. One idea could be to refocus the MIP to its initial purpose, which was to avoid a financial crisis, so the objective could be financial sustainability and macroeconomic stabilization. And then focus the instruments on something you can use in the short term and have an impact in the short term, which are mostly instruments that can be changed at the margin, like taxation, social contribution, minimum wage. And then there's a question about macroprudential policy, because macroprudential policy is something outside. It's completely separated. It's a different process. However, it's difficult to talk about macroeconomic stabilization without any eye on the credit cycle, housing prices, things like that. And there are instruments, but they are not in the same hands. So here we have something we need to work about. Then the structural reforms, which are very important, and some of them actually can help in the short term also. If you think about NPLs, changing solvency procedures, this can perhaps be done quite quickly and have an impact quite quickly. But in general, the structural reforms should all be watched with a separate process that would focus on long-term growth and with a multi-year review. Another problem with the MIP, and now I focus on the MIP, is Eurozone consistency. So the Commission starts with an alert mechanism report, which is for the euro area as a whole, and very good. It points the different imbalances in the euro area. But then when we come to the country-specific recommendation, the consistency is somewhat lost. And I will illustrate this with the case of Germany and France. So as you know, the current account in Germany has been increasing in recent years. And one source of this increase is net savings in the non-financial corporate sector. These are the yellow bar pointing upward. If you dig into these savings, we see that, in fact, investment has been relatively flat in percent of GDP, slightly declining in the non-financial corporate sector, whereas gross savings were increasing. This is in sharp contrast with France, where we have negative net savings, and with increasing investment and declining gross savings. So a standard conclusion from these pieces of evidence would be to say that investment in Germany is constrained by lack of demand, and whereas investment in France is constrained by lack of profitability. Then you would like to have country-specific recommendations that are demand side in Germany and supply side in France. So here, this is an extract of the country-specific recommendations for Germany and France. For France, it's clearly supply side. For Germany, I'm not so sure. So there is this idea to reduce the tax wage for low-wage earners, depending on the way you do it. It can be a demand side. It can be an increase in purchasing power for these people. But then, interestingly, there is the same recommendation for both countries, which is to deregulate the services sectors. So this normally should push prices downwards. So it helps in the case of France. But in the case of Germany, since, and the very tricky recommendation is to promote higher real wage growth. So if real wage growth comes from declining prices, at the level of the euro area, we are not going to reduce imbalances. And on the top of that, there is a recommendation on investment saying that the corporate income tax should be cut. If we think that investment in Germany is constrained by the lack of demand, the corporate income tax is not the issue. So it's not to conclude on that, and then I have a second issue, to conclude on that, just to say that We would like to have more consistency horizontally between the different countries to be sure that the country-specific recommendations are going to reduce the imbalances between the countries, not only inside the countries. Second, growth policies and inequalities, just a few seconds on that. I draw here on common work with Guntram Wolf and Clemens Fust and Vincent Ossiou some weeks ago, where we start with the idea that the EU doctrine is at risk today, because the EU doctrine is to boost productivity through creative destruction. So this creates losers, and due to subsidiarity, it is the task of the member states to take care of the losers, and they have somewhat failed in doing that. So although there is a lot to gain for further integration, especially in the services sectors, the population will oppose very rationally because they think this will increase inequalities. So we are blocked. And how to get out of this situation, and this is my last slide, there are two strategies. The first one is to empower member states through tax and social coordination, and here we have done very little. And the second possibility is to revisit existing or to create new instruments at the European level. We have the Globalization Adjustment Fund, which was created to accompany the structural change and for workers that lose their jobs. And to give you just one figure, in 2016, it has accompanied less than 7,000 workers for the EU 28. So perhaps something can be done for it to be more efficient. And here I wanted, we finished on that, we would like to, on the top of that, introduce the idea of timely, temporary, and targeted transfers, which would be a US-style unemployment insurance system. Why am I talking about that? So it's a way also to help the losers to accompany the transformation temporarily. But this is not the main objective here, because the transformation related to integration is structural, is long-term, and here we are talking about cyclical unemployment. So the interesting thing in this project would be to provide an incentive to reform, because you need to have some convergence of labor markets before you can introduce it is not for tomorrow. You have automatic demand stabilization, which is very interesting, because we know that discretionary demand stabilization is very tricky, and in general, it shows up pro-cyclical, in fact. And finally, and I think this is very important, we should not underestimate this, it provides solidarity, not at the country level, but at the individual level, that Erasmus has changed the life of many students. The idea is to change the life at the individual level of workers that suffer for a crisis, temporary, so it's not permanent transfer. And it's also combined with reduced distortions of mobility and investment in skills from the EU level. This could also have a positive impact on growth because in an economy that is mostly services-based. Thank you very much.
Thank you, Agnes, for reminding us that we need a lot of structural reforms, starting with the structural reform of clarifying and streamlining the SGP and the MIP procedures in the Commission, if I may. Because you showed indeed that there is need for some clarification there. So please, Sergey.
Thank you very much, Vitor. Thank you very much for inviting me here. It's a great pleasure and honor to be here at ECB conference. In our countries of operations, we EBRD are often confused with ECB. So for me, it's very important to understand what ECB does, because we are often held accountable for ECB actions. Jokes aside, this conference is about growth in advanced countries, but of course it's also very important for us. First, because growth in advanced countries has important spillovers for our countries. Second, our countries are actually approaching high income status, and many of them are facing the very same challenges. And this year's transition report will be devoted to growth challenges in middle income countries and how to get out of middle income traps. And some of the issues discussed yesterday and today are very relevant. I will talk exactly about what Vitor has suggested, namely the relationship between cycle and trend. what President Draghi mentioned yesterday is the output gap closing the wrong way, how the cycle may affect the potential growth. I will talk about 3 sources of risks, and I will try to end on a positive note. Now, the first source is, of course, very well known. When you have a crisis, if you have long-term unemployed, they lose human capital. This is especially true in our world of job polarization. Luckily, Simon will talk mostly about this, so I will not spend much time about this. And indeed, this is something which is very well studied. I would just mention that in our countries, this is a story which is understood very, very well when a long-term recession, long recession affects human capital and leaves long-term scars, persistent scars, sometimes even physically observed. So actually, last year's transition report was devoted to inclusion and inequality, and we looked at height of people who were born during the recession in the 1990s, and we found that people who were born during the height of the structural reform and recession, these people are now grown up to 1 centimeter shorter, which is actually a huge effect. So I will not talk about the human capital channel. I will talk about 2 other things. One is political economy of populism, and the other one, non-performing loans. So on political economy of populism, exactly like Marco said today or Ben Bernanke said 2 days ago, this is quite a challenge. And what we do, we don't look at the US, but we look at all European countries. What we do with my co-authors, Jan Algan, Evgenia Passari, and Elias Papagiannou, we look at European social survey at the subnational level. We don't compare Germany and Greece. We compare regions within Germany and regions within Greece, and we study how the change in unemployment before and after Great Recession affected the views of people and their voting patterns. And basically, in order to identify causal effect, we instrument unemployment change by pre-existing structure of the economy, and we find that increase in unemployment does affect trust in institutions and voting for populist parties. Regions of Europe where unemployment went up more during the crisis tend to have less trust in national politicians, in European politicians. There is no impact on trust in church or police or neighbors or strangers, but there is an effect on trust in politicians, and this effect translates in voting for extreme parties in 2014. We also did a special zoom in into Brexit, and of course we also found that even though average unemployment in Great Britain is quite low, but if you look at the municipalities where unemployment went up during the recession, you see that these are the municipalities which voted for Brexit. If unemployment didn't go up there, we would have something like 5 percentage points less vote for Brexit, and therefore a very different outcome of that vote. So why does that matter? Well, we know that Europe is very heterogeneous, and if we start looking at inequality dynamics during the crisis, actually, in most countries, inequality has come down, surprisingly. Well, if you think about this, it's not so surprising, because during the crisis, asset values go down, so richer people usually lose more wealth. But this is not the case in some European countries. So if you look at what's called elephant curves put forward by Branko Milanovic and look at which deciles of populations had seen increases or decreases in income, you will identify 5 countries in Europe where elephant curves are upward sloping, meaning that upper middle class or rich have actually done better during the crisis. We've done this analysis, and we saw that it is Portugal, Italy, Spain, Greece, and Cyprus where this elephant curve is upward sloping. Interestingly, also Hungary, also a country some people would call a country which pursues populist policies. As an EBRD employee, I would not criticize any specific country, any specific government, but I would just go back to Greece, and I would say that there, even though inequality has increased, our household surveys show that in Greece, actually pretty much across the board, that's been suffering, and in that sense, this internal devaluation process, fiscal consolidations and reforms and so on that Marco was mentioning, does create huge social implications. Basically, our survey shows that more than 90% of Greeks had to cut back on essential consumption. And in that sense, the social implication of this internal devaluation will be quite huge. Now, I would also say that when people talk about increasing inequality, it does not necessarily result in vote for populist parties. Actually, our household surveys show that when you divide inequality into inequality of opportunity, unfair inequality, and the rest is kind of attributed to talent and skills and effort, then you actually find that people are not minding the fair portion of inequality. It is the inequality of opportunity explained by exogenous factors such as parental background, place of birth, gender, ethnicity, and race. This is what people object. And in that sense, reforms that open up flexibility in markets may actually help, even if they create fair inequality. This is not only what we find, it's also what others are finding. Now, what does that mean in terms of policy? Well, of course, if we fail to create equality of opportunity, populists take over, and what do they offer? They offer now protectionism, overregulation, and eventually that results in crony capitalism. This is not what we want to pursue, and of course, the solutions that we want to pursue are the ones that Marco and Agnes have already discussed: education, public goods, accessible without with disregard of your parental background or place of birth, and so on. So mobility, and so on and so forth. Now, let me say a few words about non-performing loans. This crisis has left a large stock of non-performing loans pretty much in all countries, especially in the countries I've already mentioned, but also in many post-communist countries. Now, differently from the previous crisis, this stock of NPLs is very chronic and stagnant. It doesn't come down. And this is where the opportunity lies. We of course, understand that relationship between non-performing loans and growth is a two-way street. It's very hard to identify causality. But my colleagues in EBRD, Marina Balgova and Alex Plekhanov, they looked at 100 countries in the last 20 years, identified the episodes of NPL reductions, identified the active policy of resolution and passive procrastination policy, looked at the narratives, looked at the media, and did the matching, where they tried to look at similar episodes of NPL reduction. So their analysis identifies the returns to active resolution of NPLs of something like 2% of GDP growth over 4 years after the crisis. And in that sense, there is actually, that's actually a great opportunity. Now, we are in Europe, so we don't talk another country with a huge stock of loans and non-performing loans further east, the big dragon in the room. Luckily, it's not something we need to discuss today. Now, what is the policy response here? We actually work together with many people in the room on what's called Vienna II initiative, where we exchange best practices in addressing NPLs. And I think this is the way forward, and I think this is a source of optimism. Now, let me say a few more things about this, and I'll finish very, very soon. Basically, in the current environment, we need to think about opportunities that come from the crisis. Well, apparently, there is this quote, which has been used a lot in the recent years: never waste a good crisis. Apparently, it's attributed to Winston Churchill, like many other quotes. So basically, you do see that some crises are used to a great benefit. So talking about middle income trap, for example, South Korea was the country which came to a crisis in 1997-98 and then used it for reforming its chaebol system and continued growing after the crisis in a completely different way. So in this particular crisis, I think the stock of NPLs also suggests we may want to shift attention to equity markets, to capital markets, and develop equity finance, even in Europe, where traditionally that's not been working so well. For that, of course, we need specific reforms, capital markets union, improving governance, and so on. But the bright side of this effort is the paper that my colleague Ralph De Haas wrote together with the ECB economist Alex Popov. They actually looked at countries using equity finance and debt finance, and they showed, not surprisingly, that equity finance promotes green growth. Of course, if you invest in equity, you don't have collateral. Collateral is usually something that you have in legacy industries, mature industries, and of course, when you invest in new technology that has long-term payoff because of the issue of stranded assets, this is where the green growth is coming from. And in that sense, I think the current set of problems may not only present risks for potential growth rates, but also opportunities to make this growth both inclusive and green. And I stop here.
Very good. And finally, I give the floor to Simon, please.
Thank you very much. In early October 1957, the American public and the American policy elite had a shock. The Soviet Union had launched the first artificial satellite, Sputnik, and while well-informed Americans were expecting some development along these lines, and the Americans had their own satellite program already in the works, the Russian Soviet satellite weighed 185 pounds, which was far in excess of what the American capability was at that time. The response of President Eisenhower, Republicans and Democrats in Congress, was remarkably rational and completely bipartisan. It was, this is a problem. We should spend more money on research and development. Let's invent more science, and let's catch up with the Soviet Union and try to overtake them in some meaningful dimension. And that is what they did. And this was not an isolated episode or a single moment. From 1940 to the mid-1960s, American federal government spending on research and development, so that's the public money going into R&D, increased 20 times. These people, that generation, invented the technologies that brought you here today, including, fundamentally, well, they invented or they expanded, rolled out, and scaled up, including penicillin, the digital computer, modern aircraft engines, and GPS. Bob Gordon, I'm not sure if he's still in the room, he has a fantastic book. I'll mention it, I'll discuss it in a moment on these issues. One of his great lines is, how many robots did you meet on the way to work today? You know, so how much is any technology we're going to discuss really impacted your life? The episode I'm describing was absolutely fundamental for everything to do with the organization of modern society and the modern economy. Now, Chad Jones put up, I think, a different, related to the Gordon critique or the Gordon concerns about modern technology, and I think that Chad is right to flag it for us. Has the world changed? Have the ideas been discovered? Is it getting much harder to make progress? So the second fact I would like to put before you is with regard to more modern impact of research and development on growth. And there's obviously a very large literature on this. I don't have time to go into it all, but I commend to you a recent paper by Moretti, Steinwender, and Van Reenen, which looks at defense R&D and the impact on other types of R&D, including the private sector. And they look both in general at the data since 1987, and they look at the specific case study, which is, I think, very interesting, after 9/11 in the United States. So what they find is, in this, you might say somewhat narrower, but I think an econometric specification that we'd all be comfortable with I think about as good identification as you can get, they find a significant positive effect of public R&D on private R&D, so there's a crowding in effect. They find that it increases TFP. They find that it has a positive effect also on employment. So this is a very interesting and, I think, positive confirmation that this historic impact on public R&D continues to today in some form. But here's the third fact, which is, I think, jarring, should be jarring to any professional economist. And Chad showed you this slide already, but he showed it to you at lightning speed. So he didn't make the point, but I do hope it was imprinted subliminally on you, because he showed you the composition of R&D. It was a flash slide, which included the rise and then the fall of this federal spending on R&D in the United States. So in the mid to late 1960s, federal spending on R&D in the United States peaked around 1.7, 1.8% of GDP. It then declined to the early 1980s by about 0.5% of GDP. And since the early 1980s, it's declined by another 0.5% of GDP. So if we, in the United States, just went back to the public support for research and development that we had in the early 1980s, that would be $100 billion, roughly, extra spending on R&D in the United States. A striking number. Now, Vitor asked for policy implications, and for that to be our focus. So here's three for us Americans, but also for your consideration in Europe. The first is we should spend more on research and development at the public level. The rates of return, you know, we can argue about the magnitudes, but the rates of return are large and they're positive. Now, perhaps we are running into some more difficulties. Perhaps it gets harder to invent things. And Bob Gordon has this fantastic book that I really commend to all of you for your summer vacation reading. It's almost 800 pages long. It's not available on a Kindle. So it also solves the problem of what else you should take on vacation, because you won't be able to carry anything else. But if you can slip something else into your luggage, I recommend one of the recent books by Eric Brynjolfsson and Andy McAfee, my colleagues at MIT. They are extreme technology optimists. Bob is a real technology skeptic. You should read these two books next to each other, make up your own mind. I think it's impossible to know where the technology leads, although I'd like to be an optimist in some dimensions. But the simplest explanation I have for what Bob points out, and what we've been talking about all the conference, which is this decline in productivity that appears to predate the crisis, and we can argue about did it start in 2000 or you want to go back earlier. Well, one very obvious explanation is we stopped doing as much research relative to the size of our economies on basic science. That's a key input into this idea creation process. And I think we should address that by spending more. Now, if we had more time, we would have to talk about how to organize this R&D, what have we actually learned. You know, there was a fascinating discussion of MIT at lunch yesterday, and I do think there's some lessons from that, but I think we also have to be careful in terms of thinking about what transfers, what works in different contexts, and so on. Just saying we'll build an MIT in some other place doesn't necessarily work. I think you know that. So first policy implication for the United States, absolutely, more spending on R&D, more infrastructure for science in that way. The second policy implication is related to polarization. So I think, and this is completely consistent with, and I think we're all standing on the shoulders of David Autor and his colleagues in this work, that both from a technology impact perspective, which we talked about yesterday, and from a globalization perspective, the impact of the China shock, for example, the impact on the middle class, middle skill jobs in the United States has been extremely negative, and the impact, which was also mentioned, at least in passing at the beginning of today, has been not massive persistent unemployment, but instead a polarization of the job market. So well-educated people have done extremely well. People with less education have done very badly. This is a key fact shaping American politics and American public policy today. This is a fact that President Trump spoke to, as Ben Bernanke said. I do not think that President Trump's proposed policies will do anything to improve or reduce the polarization. I think that actually exacerbate it. We can talk about that more if you want. But frankly, the ideas proposed from the left of the political spectrum in the United States with regard to growth at this stage are not strong enough, not compelling enough, not persuasive enough. We need absolutely an agenda that gets directly at job polarization in a way that's consistent with growth and in a way that fits with what works in terms of public finance. Joel Mokyr yesterday said he wasn't worried about existing public finance and the way that we receive revenue when we have successful innovation. Well, unfortunately, that's a big part of why we spend less on public R&D now, is we haven't had a sustainable fiscal model, despite the very high rates of return. We absolutely have to change that. And I don't think it has to be, I don't think it's a left-wing idea. I don't think it's a right-wing idea. I think it's a public policy problem that we have to solve. Now, the final policy implication is this. Much as I would like to start a space race or a technology race between the United States and Europe, I don't think that's about to happen, and I don't think that it falls on me today to play that role. But here's, going back to Chad's slides again, he showed you what's happened to the number of researchers and this input into idea creation and discovery in the United States and Europe. But what he could also have shown you was what's happening in China. This is not about US versus Europe. This is about new countries rising, particularly China, putting a huge amount of effort into exactly what I'm saying today. Fundamental, basic research across science, across human health, across physics, increasingly is coming from China. I spend a lot of time talking to people and working with people on blockchain technology and also on artificial intelligence at MIT. On artificial intelligence, the two countries that lead the world are the United States and China. On papers, on research, and now this is also related to there was this momentary, I thought, great moment between Philippe and, it will grow in the retelling, don't worry guys, between Philippe and Chad, where Chad says, it's getting harder to invent ideas, Philippe said, what about the new stuff? Right? So the problem with the new stuff is, even when you're in the middle of it, you don't know, is it new, is it really going to be fundamental, and lead to the breakthroughs? But if you don't do this, if you, the people that don't do this, the Chinese will do it for you. They will be the technology leaders. They will get the jobs, the good middle-class jobs that come with technology leadership, and you won't. Thank you very much.
Thank you very much, Simon. We have now quite some time for questions, but let me ask for the first polling question now, because is that possible?
Yeah.
Yeah, okay. Just to kickstart the controversy and adding to it, something that has been present during the morning.
Question.
Yeah.
The responsibility for the slow and long recovery lies mostly with option A, lack of aggregate demand not sufficiently offset by macroeconomic policies. B, supply-side declining trends. C, a protracted debt overhang cycle. D, none of the above. So please vote. You have 1 minute.
I can.
Mostly, yeah. Oh, I forgot my.
You can raise your hand, Agnes.
So that I could
shout.
vote. No, that's not the one. This one.
Moderator cannot vote.
Okay. As the minute passed.
10 more seconds.
Oh, 10 seconds. Then I gave it up to you. I gave it back. That's not mine.
And these are the results.
Oh, interesting. So interesting. The prolonged debt overhang cycle got a high percentage of votes. Yeah. Okay. Thank you. So the floor. No, sorry. I will give a few minutes for some possible interaction between the members of the panel, if any of you want to react to something that the others said just now.
Sergey? That's a question for Simon.
Yeah. Yes.
Simon mentioned job polarization as a policy response, but for me it's a policy challenge. So what are the solutions for job polarization? Training, active labor market policies?
Sergey, I think we're all struggling with this. And, obviously, the one view from the Trump administration is that you can change trade policies in a way that will impact job polarization. I'm very skeptical that that's going to have a positive impact. I think it could actually be a negative. The major driver, I mean, David, if he's still here, can speak to this, appears to be the technology trend. And whether you think technology now is going to be slow or accelerate, everything we see in terms of that direction is that it eats, whatever form of automation you come and whatever jobs you think are automated, they are probably not your jobs and not the jobs of anybody here. They're the jobs of people who have much less education. So that is, I think, the core issue. And what I'm proposing, what I'm arguing is you need a more dramatic restructuring of the nature of the economy and the way in which we create jobs, rather than, I think what Ben Bernanke was arguing for was growth plus a change in how we redistribute, I'm not sure redistribution or changing the safety net is going to have a big impact here. I think you need a lot more growth, and more growth with a change in human capital. So education was a really big part of what the US did in the 50s and 60s. Really important, and we've stopped doing that in the same way. So transformation across the board.
Thank you. Yes, Agnes, please.
Just on this, we must not be naive. I think the word compensating the losers is tricky because I think we've seen recently with political events that people no longer want transfers, they want jobs. Yeah. And so this moves us to second kinds of policies that we didn't like regional policies, industrial policies. Maybe we have to rediscover this kind of policies, which are not what we would prefer. As in our models, we have the optimality is to allow for free market, and then you compensate the losers. But compensating the losers not through transfers, through giving them jobs, retraining, helping the regions to produce new jobs. This is much more costly than we thought. And I think it will have deep implications for policies going forward.
Well, it's a much bigger effort. I completely agree. This issue of cost is an interesting question. The question you put up, whoever designed it yesterday, had a question about public subsidies in this context. I mean, if we're talking about research and development, which is why I'm focusing on it, there's a very high social rate of return on that is extremely well documented and very robust. Now, there may be some advantages to going first, and maybe the winner-take-all economy gives Halvarian, a bigger advantage than the rest of us. But that means we should be fighting to be first in this. And then it's not clear to me that there's a social subsidy drain on the taxpayer sense. It's not clear to me there's a cost at all.
Yeah, good that you mentioned regional policy, because we have much more of that in Europe than in the US. It's a big part of the European budget. And it's very relevant, I think, and part of the difference that we find between Europe and the US in what regards assisting the losers, let's say, and helping the losers, is related with regional policy precisely. And also that, in the end, impacts also inequality. And if we look to the development of the evolution of the Gini coefficient throughout the recent years, we see that in the US it has continued to grow up all the time. In Europe, it has started to decrease since around 95. So, and since then, it has been on a slight declining path. So that makes a difference of the type of policies that we have in Europe, and certain regional policy is one of them that it is relevant coming, say, from the center, because it's the European budget that deals with it independently of monetary union. Marco?
Yes,
final word from the panel,
yeah,
and then I open to the audience.
Yes, no, on the R&D, you have seen I put up the graphs on consolidation and the change in the expenditure in public investment and in education. Had I put in the R&D, I would have had the same message, namely that the quality of public finance has deteriorated in the past years. Second point, which I think is important, and we do not ensure a proper vertical coordination between what we do at the European level on R&D and what member states are doing at the national level. So I think this coherence here is absolutely important to achieve. Just one or two points on Agnes on the MIP. One point on MIP. Okay, let me just say one thing. Okay, true that we have to clarify the matters, as sometimes we have in the past used it for imbalances or for structural reforms. On Germany in particular, we have recommendation on public investment, so to increase public investment, and on non-trade services and non-tradables, I think should we manage to convert and increase the allocation of resources towards non-tradables in Germany, I think it would help a lot also from the point of view of internal imbalances in the euro area.
Okay, we go to the audience. The only one that I noticed, because it was the first to raise his hand, was Arnold. So I ask for those who already also asked to speak to raise their hands again so that I can, yeah, okay. Benjamin?
Far left, extreme left.
Okay. François, Yanis, Otmar, yeah, okay. Very good. So Harald, please.
Yeah, Harald Uhlig, University of Chicago. So listening to the panel, the question is how to get growth going, how to sustain growth. And it sounded like the gist of what came from the panel was that it takes a lot of public spending in particular on higher education. So let me throw out some more facts here. We all agree that human capital formation and entrepreneurship is hugely important for growth. There's no accident that Silicon Valley is near Stanford. There's no accident that Kendall Square is near MIT. So it's clear that excellent universities are really key for getting these kinds of processes going. Now, if you think about the Shanghai rankings, if you think about the best universities in the world, and you think about where are they? We know they're in the United States, right? 8 of 8. If you look at the Shanghai rankings, 8 of the 10 best universities are in the United States. The other 2 are in the UK. So what's the difference between the United States and the UK, perhaps, and continental Europe? Is it public spending? Now, you could take out your Wikipedia pages and look for how much R&D spending is done by the government and so forth. But there's one difference that's very striking, and that is that these universities charge tuition. The education in the United States is privatized. They charge a huge amount of tuition. Now, there's a lot of complaint about the high tuition in the United States, right? People complain how much it costs to send your kids and pay full tuition to MIT or to Harvard or Stanford. And I understand that. It also costs me a lot of money to buy a Mercedes or Porsche. I complain about that a lot too, right? It's costly. If you want quality, you've got to pay for it. But spending on public education privately is, spending on higher education, privately is anathema in Europe. And perhaps in order to get growth going, what really should happen is not for the government to spend more, but for the government to spend less to get out of the wool of things that can be organized in private markets where private citizens earn their private benefits. Now, I totally agree that I think there should be public spending on basic research, and the United States spends a lot on that, but it's competitive. There's competitive grant giving and so forth. And I think that applies more broadly. So I think that the lesson that we can learn from higher education in particular is that maybe the key to growth is not for more fiscal spending, it's for less fiscal spending and for fiscal authorities and for public finance to get out of the wool of private markets. There's one exception, how growth might decline if you do less fiscal spending, and that's the reduction in government jobs. Now, mind you, there are lots of fine government employees that are well worth the money we spent on. I mean, I always admire, policemen that put their lives at risk for the little salary that they're getting, right? So I'm not denying there's lots of government employees,
Can you
earn their salary, but we also know many people, that sit on fine jobs, and their contribution to GDP is measured by how much we spend on them, not by what they actually produce to GDP. So if we cut their jobs, GDP will decline, but we should be really thinking about what ultimately gets produced in the economy. Thank you very much.
Yeah, thank you. Benjamin, please. Over there, yeah.
Ben Friedman, Harvard. I'd like to offer an American perspective on the one issue that we're describing. Many members of our business establishment in the United States, including leaders of operating companies as well as large financial institutions, have expressed both surprise and extreme dismay at the expression of protectionism appearing in the last election and now under the new administration. They're also surprised when they are now told that they are part of the problem. And the sense in which they are part of the problem is that, at least in our country, the business sector has been systematically opposed for several decades to any attempt to ease the transition of people who are displaced or disadvantaged by internationalization of trade. Now, they express surprise that they've been on the wrong side of that. They say, well, we're not opposed to that, but the answer is they are, and they are for two reasons. One is that, of course, these programs cost money, and therefore they require taxes. And for all of the usual reasons, the business establishment in the United States is systematically in favor of low taxes. And second, these programs are part of something that the government does, and therefore they're bad in the eyes of the business establishment, not only because they cost money, but because, since the government does it, they're bad. And therefore, in a sense, our business sector is reaping what it's sown over a very large period of time. They have been the origin and support of systematically rebuffing any effort to ease transition, to train workers, to provide alternative transition policies for those who've been disadvantaged. And now here we are 30 years later, and they're surprised that the public has voiced serious concern about globalization. Well, they're surprised, but now they have it.
Thank you, Benjamin. François, please. Sorry?
Thank you. I have two short questions for the two first panelists. Marco, thank you very much for your enlightening remarks about complementarity and substitution between fiscal policy and reforms. Isn't there an obvious complementarity, Marco, which is about the quality of fiscal policies, their contents? We speak very often, including in the ECB comments, of growth-friendly fiscal policies, but what do we mean exactly? And here, I must say, I remain a bit puzzled or disappointed by the content of what we get from academics or from ourselves. Do we mean investment expenditures, education expenditures, some kind of social transfers to compensate for reforms? We are not very clear about that. We don't help much politicians. And a last light on this, if I look at fiscal multipliers, I am always puzzled by the diversity of results we see in the literature. Is it stronger on investment, current expenditures, tax cuts, if you look from different institutions? So if I was a politician and in charge of a growth-friendly fiscal policy, how could I be helped more? My question to Agnès is about the free circles and the great clarity you have brought about the various procedures. Isn't there, in the middle of the free circles, a common black hole, so to say, that none of these procedures has clearly a Eurozone-wide stance? It's true for the fiscal stance over the external accounts. So when you speak of Eurozone consistency, this is, for me, probably a missing link.
Thank you, François. I will have one question more in this round, and I have already 4 speakers for the second round. Otmar, can you formulate your question? Yanis, you come after. Second round. Okay.
I want to make a comment on an important remark by Marco. And by that, I don't mean the label you put on me with the curse. I will not work against. I will try to deserve it also in the future. So this point I want to refer to is the important issue of the time horizon of politicians doing reforms. If you looked at Germany, Germany is lucky that the former chancellor has committed political suicide in the last year of his government, making the Schröder reforms. And when you saw the slides of Bob Hall, it seemed as if the financial crisis was the starting point for the pickup in Germany, but it was the lacked impact of the Schröder reforms. It would be very strange that in Germany, so a fiscal disaster would have, a financial disaster would have caused this growth. A remark on Agnès, you said investment in Germany is demand constrained. You mean probably public investment, because private investment, if you look, for example, in direct investment of German companies. I think all energy-intensive sectors are fleeing Germany, investing outside, because Germany has the highest energy costs probably in the world, double, 3 times as expensive as France. So it's a supply-side constraint, which is important. And the final remark on the current account issue, to be a bit provocative, I think the euro area member countries should be interested in a very high current account surplus of Germany to the rest of the world, because the import content from EU countries, also EU area countries, is very high. So this is not a disadvantage for the partners, but it's a big advantage contributing to growth, jobs, employment in partner countries.
Thank you, Otmar. So we have enough food for thought for the members of the panel. 3 of them were particularly addressed. Agnes, you want to go first?
Perhaps 3 points. So
Yeah.
the first on public spending. So I was careful enough not to talk about public spending because I wanted to prove that you can talk about the MIP without mentioning the budget. It's true that one recommendation of the Commission is more public spending in Germany, but I wanted to focus on the private sector. And on university, I think it's true that we could have more co-financing for high-level masters in the EU. But maybe the challenge for the middle class is more intermediate education. Universities that maybe are not so high-ranking, but are absolutely key for the middle class that is suffering from the polarization of the jobs. So we should not, and on here, I don't see a fully privatized system working properly. On François' remark, the Commission used to address a country-specific recommendation to the euro area. But then I was always wondering who was reading this, because there is no euro area government. So now they have stopped. There was an attempt last year to design a euro area fiscal stance, but it lasted 2 days before it was killed. And so the idea here is to make a budgetary policy without a budget, which is very difficult. So you want to use the budget of the member states to design a budget you don't have. And this doesn't work. This is why, in fact, perhaps a euro area budget may be less difficult to put in place, in fact, than coordination that we've seen is impossible. And on Otmar, the fact that private investment goes outside Germany is not a proof that it's supply constraint, because there is demand outside Germany. So this is not a proof. There's excess saving in the corporate sector. So a basic idea could be to take these savings and give them to the household, the poor household that would consume them. We know that the poverty rate in Germany has gone up relatively, is at the level of the UK, actually. So there is a margin here. So you could have these kind of ideas to increase aggregate demand. And on the current account, I think we should not confuse the current account with export shares. You can have, and Spain actually has proved that before the crisis, export shares of Spain were not so bad. They were doing quite well. And despite the fact that they had huge current account deficits, so for Germany is the same. What is good for the EU area and for the EU is to have growing market shares, or at least the market shares that don't decline too much, and not to have a current account surplus.
Thank you, Agnes. Marcos, you were addressed several times.
No, Harald, no, I mean, I take the point that just looking at input and not output is clearly a limitation. So one has to go much more into the details on this. What I observe in Europe is that unfortunately, those countries which have reduced investment in education, they have not seized the opportunity to move to a higher let's say, to push the frontier of efficiency in delivery of this. And we see a number of countries that continue to spend quite a lot on education and do that in a not very efficient manner. But I agree that one should should look at things in a much more encompassing way. On Francois, I think the problem, the issue of quality of public finance, I think absolutely essential. I think basically let's call it the wholesale consolidation in which one had to reduce the budget, I mean, whatever the means, I think is largely over. So I think the quality of public finance is increasingly important. I think here we should link the issue with the positive incentives on the delivery of structural reforms as well. On the fiscal multipliers, I mean, our own research, we have done, as many others, our own research. What you find in the positive and in the negative that with the under the zero lower bound, fiscal multipliers are very high. And there is a difference here between short-term and longer-term multiplier. But let me say one thing that definitely not, I take away my commission hat totally, even though I was not wearing it before either. But let me be a bit iconoclast here. I find that the mantra that we have carried with us of reducing taxes, so reducing taxation, the tax burden, and doing that while reducing public spending in the new world, where you have much more emphasis on inclusiveness, on the issue of complementarity between public investment, private investment, especially in material goods, where you have the R&D issues. I mean, I find that we may have reached the limit in which this mantra of doing it, by slashing public spending is, I think, is attained. On, I mean, the final point on, I think on the euro area recommendation is still there. And the euro area recommendation is supposed to be, no, you didn't find it because you didn't look well. But, and also because we have changed the timing precisely to make it more relevant. So we have anticipated it from spring to November of the previous year. So when you have the euro area recommendations, this is addressed to the Eurogroup on the delivery, and then the member states, actually, the recommendation of the member states are also formulated, taking into account the euro area recommendation. So in terms of this, of the sequencing, I think is it is, I think, the right issue.
We see how Europe can be complicated, indeed. But it's good that you reminded it is still there, as also the idea of having, for instance, a additional budgetary capacity for the euro area countries, which was in the 5 Presidents report, has been commented openly by Mrs. Merkel the other day, also by President Macron. So it's something that is apparently growing. Simon, you had several things directed to your intervention, so please.
Well, first, to the point that Ben made, I think you're exactly right with regard to the trade and the lack of trade assistance and adjustment. But let's be honest, the corporate elite is also in line to get a big tax cut now. So it's not clear to me that they're so very unhappy with the outcome. and the basic structure of public finance, which we thought would take care of reallocation or redistribution along with growth, doesn't work in the United States. It's broken completely. So I think we need something different, honestly. Now, Harold, very good points that you're making, and I'm not going to weigh in on European universities, but I would just point out or remind you that a place like MIT, I'll only speak about MIT, has a lot of public money in its history. It was a land-grant college. All the land we received was essentially from the federal government in the 1860s. And we've been historically one of the largest defense contractors in the country. And we continue to be important. And by the way, all this, the growth miracle around Kendall Square, well, those of you, I notice a lot of people have MIT in their bios. You surely remember the 1980s Kendall Square, which was such a dump that you couldn't even, that it was safe. You couldn't even get mugged. Boston was dangerous at the time. You couldn't even get mugged in the 1980s in Kendall Square because the muggers were too smart. They knew nobody had any money there. They'd all go to Central Square. So we took, I mean, you know, I think it's about, and where you're going is it's about organization, and it's about public-private partnership. And MIT was actually felt compelled by the end of the Cold War to become much more entrepreneurial. So that's a point in your favor. But we have a lot of partnership with Massachusetts and with Cambridge. Rezoning the land, a very big Ed Glazer point, is in a huge part of how they redeveloped Kendall Square. So I think organizing this and taking the basic science, making it applied, commercializing it, it's a public-private partnership for us, and I think it is will be for everyone else too.
Yeah.
Peter, can I say a few words?
Yeah, now I was giving you the floor precisely because...
I will only speak about universities because in Russia, before I had to leave Russia, I ran a private school for 9 years. And we were the first one to introduce meaningful tuition coupled with student loans, and we created endowment, we created autonomous board, and so on. And I think there is no doubt around the world that US private universities are the centers of excellence. And all other countries which build research universities somehow follow this model. But this model is not only about tuition. This model is also about giving opportunity to people who cannot pay through scholarships and student loans. I don't know what it is in Chicago, but in most top American schools, if your family makes less than $100,000 per year, you don't have to pay. You're qualified as a kind of poor, right? And on top of that, of course, it's not only land grants of public contribution. If you think about research funding of US government, what Simon is talking about, National Institute of Health, National Science Foundation, Department of Energy, all this money is public money. Many of those grants are given to private universities on a competitive basis with peer reviews. And I think this is the right model, and this is what other countries, including Europe, with European Research Council, are trying to do, and this is also a right model. Yeah. And I see Andres appear here, and I think it was a report by Andrea, but also Philippe Aguillon and Mathias de Vatripon probably 5 years ago or 7 years ago about what to do about research universities, and they advocated exactly this model, and I think it is the right way forward. Now, people would say we also need second-ranking universities without tuition. That may be true, but somebody has to teach in those universities, and the question is, where do we train professors? And for that, we, of course, need high-ranking research universities, where I fully agree with you. This should be internationally competitive. And that doesn't mean that you have to only charge tuition there. But it means that they have to be international and competitive. And they should be able to apply for American grants, Chinese grants, or European grants, whatever happens. So it's not only about tuition, but it is true that private US university is the way forward. And whatever China is doing, they also are trying to implement this model, even though in a specific Chinese way, right? With the money coming from state sector still, but on a competitive basis.
Okay, thank you, Sergey. Now I still will allow 3 questions, meaning I think that we have time to have lunch during 1 hour. It's enough in order to keep the timetable for the final panel after lunch. So I have Chad, I have Yanis, and I have Andre. So you asked for the floor, no, initially? You did, yes, absolutely. So
thank you. Chad Jones from Stanford. I had a question for Simon. So I share your concern about the decline in the share of GDP devoted to public funding for basic research. And in some sense, you addressed this a little bit already, but I also share Harold's concern that the way the government spends the money certainly matters a lot. So I wanted to give you the opportunity to offer up maybe 1 or 2 examples of specific things that you think the government could do that would be good examples of policies for publicly funding research.
Yanis, still want the floor? Yeah, okay. Our turn.
Thank you. My questions refer to the first 2 papers, Marcos and Agnes. Definitely flexible markets minimize the negative impact of fiscal consolidation. So structural reform is complementary and perhaps should be preceded fiscal consolidation. Also, from the experience of Greece, the sequencing of structural reform is important. I mean, we've done labor market first and product market later. It should have been the opposite, I think. It should have minimized the impact of fiscal consolidation if it was the other way around. Of course, also the structural reform should refer to independence of institutions. This is another lesson that we have learned. And finally, we should not forget what Agnès said on the macroeconomic imbalances procedure, especially the current account deficit and surpluses. The fact that internal devaluation in Greece had such an undesirable social consequences was because at the time that we had to cut deficits, surplus countries increased their surpluses rather than reduce it, with all due respect to Otmar.
Yeah. Thank you, Yanis. Andre, please.
Yes, thanks very much. I would like to make a comment and ask a question, both in a sense to this panel, but to the previous panels as well. So it's sort of an overall comment. It seems to me that there is one dimension that has been underrated in our discussion. It's demography. I think demography has really, it's very slow moving, and that's why it's not on the radar screen, right? We have been talking this morning partly of the short term and partly of the long term, but I think demography here, if I look at growth and the different topics we discussed this morning, I think has huge impact. First, public finance. It's all very well to say that we want to improve the quality of public finance, and we should. But it is very hard to do politically at a time of aging of population. So it means, in a sense, redirecting public finance to the younger part of the population. While, as we have seen in votes, is the older ones who are voting. And this is not easy to do. So one has to take that into account. Second issue, I wish there had been some discussion also of demography and aging on total factor productivity. I can't believe that the fact that there's been aging of population, what's happening in Japan, I think we should be discussing a little bit more Japan. We've been discussing all the time Europe versus the US. But what about Europe versus Japan? I think that's a very relevant example as well. And finally, we discussed in the first session, authors, technological change, globalization, and the impact on people and churning of jobs. But there again, I think the aging is very much of a factor. When you are losing your job in the auto sector and you are 50, it's not quite the same as losing your job when you are 20 or 30. So the resistance is much, much bigger. And I think the populism that we have seen in some of the US states is, again, very much related to aging. We know that for Brexit, we know that for Trump, it's the older workers who are more voting and who are more scared of those changes. So it seems to me that demography and the aging is a pervasive theme that should be much, much more discussed in the context of this seminar. Maybe a topic for a future meeting.
Maybe.
Thanks.
No, good points, Andre, thank you. I'll give the floor now first to Simon to answer Chad's question.
So John Gruber and I have a specific proposal that I'd like to discuss with you and anyone else offline with some detail. I think the basic model that we have in the US is the model designed by Vannevar Bush, who was also an MIT professor in the 1940s, which is you have the public-private partnership, you use the public money to catalyze the private activity, and I think more of that and more state-local buy-in, because that's absolutely essential if you're going to build more clusters or spread the R&D around. The alternative, of course, is we just do more at Stanford and MIT. That's, maybe you get more productivity from in terms of finding new ideas, but it's awfully expensive to do the R&D there, in part because of the real estate and the cost of talent there, as opposed to doing it in other parts of the United States. So there are some strategic choices to be made, but I think the basic competitive model is exactly what we should keep doing. Scale it up, or go back to where we were in the United States. I'd like to make a comment on demography, which I think is, on the demographic point, I think is exactly right. And the key issue in the United States is, can we continue with our current levels of legal immigration? It is more than ironic that Steve Mnuchin, the Treasury Secretary, talks all the time about achieving 3% growth, and yet members of his party, influential members, are talking about reducing legal immigration from where it is now, about 1 million to 500,000 or less. That would have a major negative impact on everything in the United States and compound all the problems that we have. But I'm afraid that's where we are politically.
Yeah. same in Europe, by the way. Marco, you want to say something?
Yes, on Yannis, I think the point on the sequencing of reforms is absolutely spot on. I think we should have done much more earlier on the product market reforms compared to the labor market reforms. I think this has, let's say, has an economic justification in terms of the, let's say, reducing rents and the possibility, let's say, to, when the labor market reform kick in, to have the positive effects. The second thing is also in terms of political economy, because the difficulty there is that you are touching, vested interest. So it's much more difficult then to do the fiscal consolidation and to do labor market reforms if, in a sense, you shield certain part of the population. And unfortunately, if you look at the delivery on the country-specific recommendations we have looked at over the past years, I think where we are lacking most is precisely in, let's say, in product market reforms. So I think much more emphasis on that. And I think on demography, I think I agree with Andre. I mean, to a certain extent, pension reforms have been one of the success stories in the past several years. And if one looks at our indicators on long-term sustainability, I mean, actually they have improved in many countries. And with the countries having large stock of debt, with so in the medium-term acute sustainability problems, actually, if one looks beyond that, you have the problem is becoming, I mean, less important. In terms of the implementation of the fiscal rules, actually, we have a specific clause for pension reforms within the Stability Pact to, to allow the delivery of this.
Yeah, but we had yesterday a nice chart showing that 8 countries were above in product market regulation above the US many years ago, and now are all below. So something has been done also in Europe in what regards reforms, not in all countries, but certainly in several important ones that happened. And yes, please.
Very shortly,
yes.
On Greece, I agree, but there was also a problem of pass-through of lower wages onto prices. It was very much delayed, so this didn't help. But it's right, and well.
Okay.
I'll just say a few words about demography. I fully agree. Yeah. It's a very important issue, and I wanted to talk about this, but I only had 10 minutes. And I think this is also an issue which is even more important for our countries. We have the same aging problem in Central and Eastern Europe and Baltics, and on top of that, we have a brain drain problem. Some of our countries have 5% of their population working in London alone, not just in the UK, but in one city. And these, of course, are younger and better educated people. So the consequences for entrepreneurship and growth are huge. And this is also where cycle hits trend, because during the cycle, these people leave, and that undermines entrepreneurship. I'm not ageist. I'm not going to say that people with gray hair are not doing entrepreneurial business. They do. But of course, by definition, as you rightly said, if you're young, you are more risk-loving, you can take risks, and that's how it works. And we have the data which shows younger people do start companies. Maybe they're irrationally optimist, irrationally overconfident, but that's the fact. And so this is a challenge for our countries. And actually this year in this transition report on growth I mentioned, we will look at demography as well. So if there is a topic next year, I'll be happy to present some stuff.
Okay. Thank you very much. And we have to end here, unfortunately. No time for more questions. But I think we should thank the panel for all their contributions. Very good.
And before you all head off,